In under a year, a stock that traded near $90 a share collapsed to less than a single dollar. Around 20,000 people lost their jobs, and many lost the retirement savings they had tied up in that same stock. At its peak, it was the seventh largest company in America, worth about $70 billion, and celebrated as a symbol of the new economy. And almost none of its reported profit was as real as it looked. To understand the fall, you first have to understand how convincing the rise was. Enron was a Houston energy company. It started by moving natural gas through pipelines, but in the 1990s, it reinvented itself as a trading powerhouse. It bought and sold contracts for energy, and eventually for almost anything, from electricity to weather to internet capacity. Wall Street loved it. The stock climbed year after year. For 6 straight years, a leading business magazine named Enron the most innovative company in America. The chief executive, Jeff Skilling, was seen as a visionary who had rebuilt the entire business model. The founder and chairman, Ken Lay, was the friendly public face of it all, deeply connected to Washington and to Houston high society. When Enron spoke, powerful people listened. From the outside, Enron looked like the future of American business, but the machine that produced those beautiful numbers had a trick built into its core. The first part of the trick was an accounting method called mark-to-market. Normally, a company records profit as the money actually arrives, year by year. Mark-to-market let Enron do something bolder. When it signed a long-term deal, it could book all of the expected future profit right away. So Enron would estimate what a 20-year contract might earn across its entire life, and then count that hopeful estimate as profit today. The estimate was set by Enron itself. If the deal later lost money, the glowing profit had already been reported. The loss was somebody else's problem. It was like counting 20 years of a paycheck the moment you were hired, and then hoping the job worked out. That kept the profits looking spectacular. But it created a second problem the company had to hide. Because if the real cash was not there and the debts were piling up, where did all that debt go? That is where the real machinery was hidden. And it is the part almost nobody outside the company understood. The chief financial officer, Andrew Fastow, engineered the answer. He built a sprawling web of separate companies called special purpose entities. On paper, each one looked like an independent business, standing on its own. In reality, many were controlled by Enron and by Fastow himself, with names like LJM and the Raptors. Enron would then move its debt and its failing investments into these entities, shifting the ugly parts of the balance sheet out of sight. The debt vanished from Enron's own books, so the company looked far healthier than it truly was. Billions of dollars in obligations were tucked away where investors could not easily see them, and Fastow ran some of these entities on the side, which meant he could personally profit from deals with his own employer. Skilling championed the aggressive culture. Lay was the face who reassured the public. Fastow built the structures. For a while, it all held together, but a machine that hides losses can only run so long. The first real cracks came not from regulators, but from people who simply asked hard questions. In 2001, a short seller named Jim Chanos studied Enron's filings and bet the stock would fall. He noticed something strange. For a business reporting such enormous profits, Enron was generating remarkably little actual cash, and its returns did not add up. That same year, a journalist named Bethany McLean wrote an article with a simple, dangerous title: "Is Enron Overpriced?" She pointed out that even experts could not clearly explain how Enron actually made its money. Inside the company, an executive named Sherron Watkins saw the danger up close. In 2001, she warned Ken Lay directly, in writing, that the company might implode in a wave of accounting scandals. It was a warning from someone on the inside who could see the edge of the cliff. The questions were now out in the open, but the full scale of the damage was still hidden. Then, in the autumn of 2001, the hiding stopped working. Enron announced a stunning loss and slashed the value of its own shareholder equity by over $1 billion. Regulators opened an investigation. Soon, the company was forced to admit that it had overstated its profits across several years, and that the numbers investors had trusted were simply wrong. As the truth spread, the stock went into free fall. Trust evaporated in weeks. A rival tried to buy Enron to rescue it, then walked away once it saw the real numbers. In December 2001, Enron filed for bankruptcy. At the time, it was the largest corporate bankruptcy in United States history. The stock that had traded near $90 was now worth pennies. And for the employees, the collapse was personal in the cruelest way. Around 20,000 workers lost their jobs. Many had their retirement plans loaded with Enron stock that was now nearly worthless. People who had done nothing wrong, who had simply believed in their employer, watched their life savings disappear alongside the company in a matter of weeks. When the collapse came, the search for who was responsible began, and it reached beyond Enron itself. Enron's accounting firm was Arthur Andersen, one of the most respected names in the business. As investigators closed in, Andersen employees shredded a large volume of Enron-related documents. Destroying paper does not destroy the truth, and it drew the authorities in even harder. The firm was convicted of obstruction of justice, and the once mighty auditor collapsed. Years later, in 2005, the Supreme Court overturned that conviction, but it came far too late to save the firm. The executives faced justice too, and their outcomes were very different. Jeff Skilling, the chief executive, was convicted in 2006 and sent to prison. He was released years later, in 2019. Andrew Fastow, the chief financial officer who built the hidden entities, cooperated with prosecutors. He pleaded guilty and served about 6 years in prison. Ken Lay, the chairman, was also convicted in 2006, but he died of a heart attack before he could be sentenced. Because he died before sentencing and could no longer appeal, a court later vacated his conviction. In the end, shareholders lost an estimated $74 billion in value. A company once worth around $70 billion had been hollowed out from the inside by its own numbers. So what did the wreckage of Enron actually change? The scandal shook public trust in corporate accounting and in the auditors meant to police it. In response, in 2002, Congress passed a sweeping law known as the Sarbanes-Oxley Act. It forced tougher financial reporting, stronger internal controls, and real accountability for the executives who sign off on the books. Chief executives could no longer simply claim they had no idea. But Enron's real lesson is quieter and more uncomfortable. Numbers on a page are only ever as honest as the people who put them there. A company can look like the future, win every award, and still be built on profit that was never truly earned. If a story like this stayed with you, subscribe and follow Paper Trails for more true tales of money gone wrong.